Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Bob. It's great to have you on the podcast. I'm a big fan of you and I've been following you on Twitter, on a regular basis. You provide some really good insights.
Thanks so much for having me. Excited to be here.
Now, before we go into the meat of our conversation, I always like to ask my guests something about their origin story. What did you study at university? Was it inevitable you'd end up in finance? And just something about some of the key milestones in your career up until now.
Yeah, for sure. I mean, my career, my academic career was actually very different from finance. I was a botanist by academic training. I actually spent a fair amount of time in high school and in college in the biological laboratory studying plants and how to make them more efficient in terms of their growth. And really, it's kind of interesting. I think what I've found is that people who come from non-traditional backgrounds often find success in finance because they're bringing a unique perspective. If you've been trained just like the countless others in the same books and the same frameworks and the same ways of thinking, I think, you often fall into the ruts and the assumptions that many others fall into. And so in a lot of ways, I think I think coming from a unique perspective in one form or another really is a way to create differentiated insight, which is ultimately, if you're trading markets, you have to have differentiated insight, right? You can't just go with the consensus. And I find in particular, the sciences are really great, people who have been in the sciences, because it's that balance between, asking questions, quantitative reasoning, theory, and rigor, which, I think in many ways are all the pieces that you need in order to be a good, at least macro-oriented investor when over time.
And how did you know as a botanist to go into finance? I mean, how did you know about the financial industry? Because I imagine if you're a botanist, you're kind of in a different world, your mind's in a different world. So that transition to finance is not obvious.
It's not obvious. And part of what I also did in school was I worked in a lot of sort of as my personal interest and my academic interest was in development economics and in global public health issues. And so in a lot of ways, my experience in global public health really kind of highlighted to me that in the end, the thing that actually drives a lot of the public health outcomes that we see on an ongoing basis is actually the macroeconomic dynamics of those economies and their circumstances. And so that sort of got me interested in macroeconomics, recognizing that that's what drove the outcomes. And so, originally I went to Bridgewater, and originally my idea was that I would just sort of go and get sort of a master's degree. They'd pay for my master's degree in macroeconomics, and then I'd go on to do something else. And 15 years later, I was still there.
And Bridgewater, of course, it's Ray Dalio's fund. It's fantastically successful. It has a very unique culture as well. And you were at the heart of it in many ways. You worked directly with Ray, and you contributed and wrote for the famous daily observations.
Yes.
Yes. So tell me, I mean, what are some of the lessons you learned during your time there at Bridgewater?
Yeah, well, I think there's a lot to summarize. 15 years to summarize in a short answer, but I think at its core, what a key part of what I learned was to think hard about what your assumptions are or your theories are, and go and test those ideas. Too often people in the financial markets have theories or assumptions about the way that things work. And when you go and test those ideas over time, what you find is that, maybe they're right in a short period of time, but they don't necessarily have this type of consistency in delivering alpha or delivering unique insight over time. And so I think that's one of the things that was really critical to my experience there, was developing that understanding in the same way. And to connect it to the experiences in the sciences, like in the same way, you theorize in the sciences, and then you go test and prove whether they're that is really true. I think that idea of connecting the theory to the proof, to the rigorous proof, not just did it work in one economy one time in 1 year, but the rigorous proof of is this something to be relied on? Is this insight something to be relied on? Or is this something that we can't rely on over time? And so that really was probably the biggest takeaway I had from my time at Bridgewater.
One question around that is, financial markets are odd in the way that things tend to be quite unstable, and there's this reflexive dynamic, this endogeneity within the system where, if everyone thinks a certain way, then the market will incorporate that and it will behave in a different way. So when you're trying to look for those relationships that hold consistently over time, do you find that as soon as you discover that they are consistent over time, they stop working, and then it's something else that comes up? I mean, how do you sort of reconcile the kind of instability of relationships that you tend to find in markets?
Yeah, I mean, I think it's a good question, and I think those folks who are looking for very tactical descriptions of what's likely to occur in markets fall into that circumstance all the time, where something looks good for a little bit and then it doesn't look good again, and then the masses sort of say this is what we should be doing, and then the masses move on to another indicator, like what's the indicator of the day, that net liquidity indicator, which is looks like it is related, but wasn't related until a year ago, may not be related in the future. And so I think part of what I really focused on is, instead of trying to understand these sort of in fashion indicators, instead it's a lot better to understand things that over long periods of time will give you an edge, right? So just to try and give you that sort of 60-40 edge or 55-45 edge, not something that is going to be descriptive, perfectly descriptive over any time frame, over any instantaneous or short time frame. Because if what you can do is you can take those 60-40 insights, and what you do from there is you can bet on them over and over and over and over again, well, then what you have is you have a higher probability of being successful durably over time. And so I think in a lot of ways, there's a lot of incentives for short-term sort of now alpha. And the reality is that, I should say, short-term, very high ratio now alpha is really what everyone is trying to find out there. And instead, I think what you see from the biggest, most successful asset managers is slow alpha that's kind of good, well diversified, is actually the ticket to success. And so that's from a theory or an investment management perspective, that's really where I've focused my attention over the course of the last 20 years.
And I'll come back to that. But maybe in terms of these relationships, we could maybe zoom into a particular topic of the last few years, which is inflation. So, I guess one thing I'd ask you is, what do you think has caused inflation in the US, if we narrow it down to the US? And what's your view at the moment in terms of where you think it will unfold? And what mistake do you think people are making currently about inflation?
Well, I don't know. We have all morning to talk about inflation. No. It is. It's complicated. That's the first answer. It's complicated, and inflation in many ways is a challenging dynamic for a couple of reasons. One, we're not familiar with it. I mean, most of us are not familiar with it. Most of us have never lived through an inflationary dynamic. And then second is, it's an interesting dynamic that's somewhere between a macroeconomic dynamic and a psychological phenomenon. And that is a very challenging place to try and think and understand about how things work. And so I think, what I would say in terms of what's going on in the US in some ways is pretty normal, but unfamiliar, in the sense of what we saw is a relatively significant supply shock that created an elevation of prices. The fiscal authorities eased into that supply shock, which is quite frequent. If you go back and look at inflationary episodes in the past, like fiscal easing during initial supply side inflation shocks is a very normal behavior. And what that did is they gave people money to be able to meet those elevated prices and continue their spending without the type of economic contraction that would typically be needed in order to ensure that that inflation didn't move into the rest of the economy. And so the outcome of that is, again, largely what you'd expect, which is once the supply shock started to get resolved, the fact that there was elevated inflation started to create a change in people's incentives in terms of negotiating for higher wages, in particular because the labor market and growth was pretty good, right? If we had had unemployment at 15%, if it had continued at 15% after COVID, then there would be no inflation, right? We wouldn't have this problem. But instead, what happened was the economy was relatively strong and unemployment relatively low, which gave workers the ability to negotiate for higher wages. And it's that part of the cycle, transitioning from that supply shock met with easing to that persistence. Spiral is not the right word. This isn't spiral. Spirals are really a currency problem, not a domestic inflationary problem. What we have is a persistence. And so that's what we're seeing is elevated wages are leading to elevated nominal spending, which is considerably higher than the productive capacity of the economy. And that means prices are staying elevated. And so that feedback loop is something that can continue as long as you have labor markets that are relatively tight. That can continue, we can continue giving 6% wage growth outcomes and have people continue to spend at a pace about 6% on a nominal basis and have productive capacity in the US economy, but also in the UK and Europe. And the story is mostly, it's pretty similar in those other economies. And continue to have inflation run at 5 or 6%. Like that can continue. That is a stable state in an economy. And really what's happening is the central banks, the ECB, the BOE, the Fed, Canada and Australia as well, are just trying to break that relatively stable equilibrium that we've now gotten ourselves into.
But what about the Fed hikes then? You didn't mention as much that the Fed eased after COVID and whether that led to the inflation or not. And if the unwind with the Fed hikes will then reverse that.
Yeah, certainly part of the stimulative response to the supply side shocks and the overall weakness that came from COVID was, the Fed was certainly an important component of that. And the printing of money helped finance those fiscal deficits, those significant fiscal deficits, which put money in the hands of spenders and helps create the persistence in that inflationary dynamic. So that was certainly an important component of the story. I think what we're seeing now, I think we take a step back for those folks who haven't traded through the last 15 years or so. A big part of the story back, in 2009, 10, 11, 12 was, can the Fed do enough to stimulate the economy to get growth going? And the reason why that was a challenge is because interest rates were at zero and the Fed was, printing money in order to stimulate asset prices, but it just wasn't enough to get particularly the lower income quintiles to be able to pick up their spending, pick up their borrowing. And that makes sense because they weren't particularly sensitive to what happens in the equity markets. Well, I think in a lot of ways, what we're seeing today is a similar dynamic. It's just in the opposite direction, which is years of easy monetary policy has allowed basically anyone who has any debt to refinance it at, zero or very low, which means that they're not particularly sensitive to changes in the short end, like corporate financing costs today. The change in corporate financing costs over the course of the last year has essentially been zero. Whereas if you went back to the 70s, because they borrowed much more on the short end, you saw big swings that were basically commensurate with what was going on with short-term interest rates. And so corporates are not sensitive to interest rate hikes. Households are not sensitive to interest rate hikes, to be clear, in the United States in particular. And so the result is, like, what's going on? Well, the Fed basically only has the asset price channel to use because the interest rates aren't really making much of a difference. And that asset price channel, first of all, hasn't been so effective. Like, S&P 500 today is above where it was when Powell started tightening. So, first of all, it's not working. And second of all, even if it was working, it's pretty slow moving. It's not a particularly effective tool. And so the Fed is kind of stuck in this position where they need to break that wage to spending to prices cycle, but the tools that they have at their disposal are not very good.
And so it sounds like your outlook is that inflation will remain quite high, in the 4.5%, 5%, 6% mark for the foreseeable future. Is that a fair characterization?
Well, I think, all of these things are on the margin. Like on the margin, the Fed tightening is doing a little something. The economy is slowing down a little bit. The labor markets are softening a tad, right? Like there is this glacial move that's going on in terms of bringing the economy, slowing down the economy. And so I'd be remiss to say, oh, well, the economy is basically where it was a year ago. Exactly. That's not really right. The question is more about going back to this sort of macroeconomic dynamic versus psychological phenomenon. The real question is, how do these things, there's a race going on, at least in the US context, and the race is between inflation being elevated for long enough that it becomes increasingly entrenched against the Fed's steps to slow down the economy. And so that's the race we're on. And right now, if you look at what's going on, like core inflation, core PCE in the US hasn't changed in 6 months on a month over month annualized basis. Core inflation in the UK is actually reaching new highs. Core inflation in Europe is quite elevated at above 5%. And so if I look at that race and I see what's going on, even though all these economies, right, are slowing down modestly, it looks like in that race between entrenchment and slowing, it looks like entrenchment's winning. And so that means, that doesn't mean that we'll never get back to our target, or that it'll take a horrendous, depression or recession to get back to our target. But every day that entrenchment continues, it just makes it more and more difficult to start to bring that inflation down. And I think that's basically what we're seeing.
And on the entrenched views, what's interesting is that if you look at inflation expectations, they haven't really risen a huge amount or outside historical ranges. So if you look at tips markets, like the 5-year inflation, it's not outside of any like recent historical ranges, at least if you go back to the 2000s. If you look at the Michigan, long-term inflation expectations, they don't look dramatically that high. If you look at consensus forecast for inflation for the next year or two, the markets are looking for inflation to decline. So it doesn't seem like there is this entrenched belief that inflation is going to remain high. So is it your view that you think these inflation expectations will end up, picking up, and that's the entrenchment that you're talking about?
Yeah, I mean, it's almost like all the macroeconomic modelers just typed in 2% into their Excel files, hard coded the value, and then like moved on to something else, right? That's what it looks like. Because like in the US, despite the fact that core is where it is, and we've had years of elevated inflation, like 5-year break-evens are at cycle lows and at 2%. I mean, that's pretty amazing to think that at least in the financial markets, people are expecting such a low inflation rate over the course of the next 5 years. I think there's a couple things to think about related to that. First of all, there is always this general dynamic, which is people expect the future to be very similar to the past, and so are essentially pricing in a return to normalcy. And you've seen that through the course of this inflationary cycle, right? Like if you had looked at 1-year inflation expectations over the course of the cycle, say starting in January 2021 and then going up until today, what you'd see is they basically all expected inflation to go back to 2%. And yet, where are we in core? We're basically flat at 5, right? The same is true in the UK and the same is true in Europe. And so the first initial thought would be like, there's no reason to believe that those expectations are right. I mean, they very well could be wrong. I think, the other thing that is going on, and I haven't gotten a crystal clear answer from those people who are trading in the bond market, but it does seem like what's happening is most of the expectations of elevated interest rates is being priced through the real yield rather than through break evens. And that could be a function of the fact that people aren't, that you have different traders, trading different points of the curve, different instruments, and that in some ways what's happening is the idea that the Fed needs to do considerably more, which is reflected in strategically higher or longer term higher real interest rates, is the break-even inflation expectation is essentially just the mechanical offset of that, right? That basically what they're saying is, well, look, overall interest rates need to be higher over the 5-year time frame than what they thought 6 or 8 weeks ago, and that can get solved in a bunch of different ways. One way that could get solved is that the Fed could be much tighter with real interest rates for much longer, and then that would bring inflation back to the 2%. And for someone trading the nominal bonds, you don't really care too much. Like, is it break evens? Is it real yields? You just care about what the weighted average interest rate is over the time frame. And so in some ways, I think the over focus on the break even market might be misleading. And it might be better to just look at nominal bonds and just see what's going on there.
Okay. Yeah. And so, I mean, what's your base case then for the Fed?
For them to continue to tighten interest rates.
And how high do you think they'll end up going?
Well, I think that has, there's been a lot of, over the course of the last 18 months, a lot of focus on what is the terminal rate, what's the terminal rate. And I think in a lot of ways that has handicapped a lot of investors who have put lines in the sand to say, oh, it's definitely going to be this, or it's definitely going to be that, in an environment where we don't know. And to be clear, the Fed doesn't know, you don't know, I don't know, we don't know. We don't know where the terminal rate will be because we're engaged in an economy that looks very different from what the 2008 cycle looks like or what the 2000 cycle looked like, given the amount of liquidity in the system, given the refinancing, given the low sensitivity to interest rate rises or the reduced sensitivity to interest rate rises. And so in a lot of ways, when I look at how to navigate, and this is what I've done for the last 18 months, is recognize that I'm not sure exactly how this is going to transpire. I have this intuition that it's going to take more tightening than a typical cycle. But you got to sit there and be flexible. Like, look at what's happening with the economy, look at what's happening with the tightening, and kind of feel your way into understanding whether or not we've done enough or not. And in an era, some people could say, well, that's backward looking. You should put your line in the sand and say that that's exactly how it's going to work. But when your uncertainty is high, which is definitely the circumstance today, flexibility is key. Flexibility and responsiveness is key in terms of navigating what's likely to go on. And so that's really, that served me well over the last 18 months, is recognizing my uncertainty about exactly all the elasticities and sensitivities in the economy to interest rates. And when I look at it today, what I'd say is, big picture, stocks are basically where they were when we started. Unemployment rate is at secular lows. Core inflation has been at 5% annualized for the last 6 months. Interest rates are basically short-term rates are basically at where core inflation is. Like, growth, it looks a little bit above potential, give or take. Maybe it's a little at potential, a little bit above. Let's not get too worried about it. It's certainly not falling rapidly. By anyone's measure, it's not falling rapidly. And so I look at that and I say, probably more is what I would say, against a pricing, at least right now, that looks like it's pricing in not much more. And so that's a trade. A bit more against not much more is a trade. I think actually in some ways, other places, we were talking today, the day of ECB meeting, who just hiked 25 basis points. I think probably there's actually, I find Europe to be probably a more interesting trade, given the level of core inflation and the magnitude of the relatively de minimis tightening priced in, the current level of interest rates. That's probably more interesting today than the U.S. In terms of like a 2-year bond short or 2-year note short. But the U.S. is probably higher than what's currently priced in.
And when I speak to investors, many of them are sort of pointing to some of the more negative or dovish data releases that we've had. So obviously, commodity prices have generally fallen. Oil prices are relatively low. the ISM, PMI type data have generally been on the weaker side. Jobless claims have started to tick up. The most recent average hourly earnings from the last payrolls report in the US picked up, wasn't very strong. So people are pointing to all of these sorts of factors, saying that we're at the cusp of a slowdown, or we're losing momentum, which will then validate this view that the Fed's done or central banks are done. On top of that, we have the regional bank issues looming in the background. So what do you say to this laundry list of factors that people typically point to say that we're at the end of the Fed hiking cycle?
Well, I think they're talking their book, right? I mean, asset managers really want lower interest rates. It's like, so first of all, anytime you see what's going on with someone who's talking, if you have an asset manager who says interest rates should be lower, like let's first of all just like recognize the bias and maybe not even the bias, the hope, right? The hope that they get what they're looking for. Like I think it's the sort of thing where you've got to be very you have to be data oriented in terms of evaluating what's going on, but you also have to be critical. And I think that's a very important thing to think about when you're evaluating what's happening, is that level of critically evaluating the goodness of the things that you're seeing. And so, as an example, go look at the services PMIs in the US over the course of the last 3, 4, 10 years. They're like uncorrelated to actual services demand. Okay, well, so you can talk about the services PMI till you're blue in the face, but I don't care because it's a terrible indicator, right? I don't even look at it. It's not worth looking at. In fact, it's an indication of not rigorous analysis. If someone is talking to you about the services PMI and not recognizing and not acknowledging the fact that it is a bad indicator that has served very little purpose over the course of the last 10 years. So that's an example. I could go down the stack here, but I think that's a really bring the level of rigorousness and comprehensiveness. So for all of those different conversations, often people will focus on manufacturing. Manufacturing is, a small portion of employment. It's a very small portion of demand. Services is a much bigger thing. People focus on surveys. Surveys are a lot weaker. There's a fair amount of academic research on surveys suggesting that political or partisan bias is an important contributing factor to those surveys, which has created a structurally worse ability to infer actual or observed outcomes through the lens of those surveys. So you start to go through that cycle, right? And I think that really, for me, when I talk to people, a lot of what they're looking at are these inferential indicators and the survey-based indicators and the soft data. And what's really shown over the course of the last 12, 18, 24 months is that the soft data has been wrong, plain and simple wrong. And so go to the hard data and go to the comprehensive hard data, right? And so you've got to talk about the fact that non-resi structures are actually expanding. You got to talk about the fact that housing compressed, but is now actually showing signs of picking up. You got to talk about payrolls, household survey, strong, right? Continuing claims, strong. Like those are real in the sense of they are measures of actual activity, even industrial production. A lot of talk about how terrible are the PMIs. Go look at the industrial production data. It's like fine, it's not great, it's not booming, but it's certainly not like we're in a terrible, disastrous recession the way you might think if you looked at the PMIs. And so go look at the hard data, go look at the comprehensive set of hard data. And when you do that, what you see is, things are fine, right? Things were booming last year. They're kind of okay this year, but kind of okay and secularly low unemployment is leading to nominal wage growth that remains elevated. And that elevated nominal wage growth is the thing that's driving inflation. And that's the thing that matters. And so until we start to get to a point where there's sufficient easing of the tightness in the labor markets to slow that wage income, right? We're not going to break the back of inflation. And right now we're not there, plain and simple.
And of course, we have had lots of interest rate hikes, and so one question that we often have to think about is which financial bubbles should burst with higher interest rates. Often you do get decoupling between the real economy and the financial markets. And so is there something in the financial markets that should blow up at these levels of interest rates? We have seen obviously some turmoil in regional banks. Obviously last year, equity markets sort of fell and bounced back since then. Are there certain pockets of the financial markets you think are particularly vulnerable to higher interest rates?
I mean, the big picture story that we have to recognize is that the real economy and even the financial economy is a lot more insulated to interest rate moves than where we were in previous cycles. And I think, for those of us who were trading markets back before 2008 and really understood how the composition and the structure of the financial economy back then, I think most people who knew and understood how the pipes worked back then versus understanding how the pipes work today and the economic condition of the financial intermediaries, what you'd say is, wow, things have changed a lot, right? Like in 2008, banks were capitalized, had 3% capitalization rates. Today it's 15. I mean, wow, that is a big difference. You know what I mean? Like that is a radical difference in terms of the most highly levered entities in the markets. In fact, when you look at the problem that we experienced, right, with the regional banks, what was the problem that we experienced? Well, I mean, there was duration issues, right? They had too much duration risk, which created a mark-to-market issue, which created a bank run. Okay, well, that is, no banks can withstand bank runs. But the interesting thing is that mark-to-market risk, it really wasn't that bad because the bonds that they were holding were money good at par, right? And of course, if you mark to market those bonds in an immediate sense, you create that imbalance between the value of the deposits and the value of the assets. But if those bonds were held to maturity, most likely the lifetime cost of the deposits would have been considerably lower than even the low yield on the bonds, which would have led to the fact that the banks, might kind of stink as a business, might be kind of not particularly profitable. But it doesn't mean that they were likely to fail. And so the Fed mostly has resolved that situation, right, by providing unlimited liquidity at par against those instruments until the point in which they mature, at par. And so, that core issue is basically behind us. And so now, taking a step back, scan the lens of the universe of creditors, right? Leveraged creditors are what create self-reinforcing downward dynamics in financial markets. The banks are not big leveraged creditors. They're much more insulated and well-regulated. The insurance companies, which we don't have time to go into all the details, are very well matched and very well managed as a function of the lessons learned in 2008. Those are typically the big, in 2008, those were the big entities that caused all the problems, right? The banks were broke and the insurance companies were broke. Today, a lot of the credit cycle, a lot of the credit dynamic has moved into things like private credit and vehicles like that. And a lot of those vehicles, maybe they have one turn of leverage, right? They're 50% debt, 50% effective equity from the strategic allocators that are giving the money, the unleveraged strategic allocators that are giving the money, but they're not, one turn of leverage. Like, who cares? Or even the CRE stuff, people look at it, they're like, well, CRE prices are going to go down. Yeah, but the LTVs are 50%. Like, we can deal with that problem. That I wouldn't want to be an equity holder in that, right? Like, that will suck. But if you have 50% LTVs, like, how bad can it really be? Even at cap rates that we're likely to see, reset cap rates we're likely to see, like, it's just, the whole system is just a lot less leveraged to the interest rate dynamic than we were 10 or 15 years ago.
And then outside of the US, you mentioned Europe looks interesting to you, where you think the inflation dynamics are more persistent than what the market's expecting. What else outside of the US do you find interesting?
Well, find it all interesting. No, I think the thing that's most interesting to me, and from a from a macroeconomic lens is that for most of us, myself included, haven't experienced an inflationary cycle. And so part of and certainly haven't in the modern era. And so part of what we need to do as macroeconomists and as macro traders is to try and up our sample size in terms of our understanding. And so one of the ways to do that is go back and look at the 70s, which, anyway, is relevant, but there's obviously some aspects of the US economy and the global economy looks very different today than it did back in the 70s. So, it's only so relatable. I think the thing that's interesting is we have more sample size because we can go look at the dynamics in Europe, the UK, Australia, Canada, right? Those are, we've just, if you're a US trader, we've just increased our sample size by like 5x, right? By looking at those economies and seeing the dynamics and how they're playing out there today. And so I think in many ways, for me, that's the thing that's interesting is this intuition about the challenges of bringing down inflation. Are we seeing the same sorts of indications in other economies, particularly in economies that should be more sensitive to interest rates? I mean, we know the UK is more sensitive. We know that, certain European economies, I mean, in Australia, heck, you have almost automatic resets of what's going on, in terms of your interest component of your mortgages. And so, I look at all that and I say, those are good petri dishes, lenses to look at how this inflation dynamic plays out. And I think the big lesson that you see in basically all these cases is it's darn hard to bring down inflation, even when you have a high short rate sensitivity, even when you have, less tight labor markets, even when you have, a big supply of external labor coming in, like still very hard to bring down inflation. And that highlights how challenging we're likely to see this whole dynamic play out.
No, that all makes sense. Very compelling case there. And, going back to alpha, you talked at the beginning about short-term alpha with a high hit rate versus long-term alpha with hit rate may not be as high, but it's a kind of a, playing the long game, it's a marathon, not the sprint. So can you talk more about the philosophy behind that? Obviously, Bridgewater is known for its all-weather fund. Is this what we're talking about, or what was this framework that you were referring to earlier?
Yeah. I mean, the all-weather fund is just a better constructed passive portfolio. I think it is not intended to generate alpha, except maybe depending on how you think about it, that might be alpha relative to a 60-40 strategic portfolio. I think I'm a lot more focused on alpha in terms of trading alpha, where we've really had over the course of the last the last 10 years or something like that, this real focus on how in the alpha, in the like hedge fund or alpha generating community, this real focus on how do you create 3 or 4 or 5 Sharpe ratio type return streams that are highly effective. And the answer is they don't exist. And I think that's one of the things that, I'll talk to an allocator, they'll say, well, we only want, 2+ Sharpe ratio return managers with double-digit returns and no years of loss over the last 5 years. And I'm like, well, what's that? I say, well, that sounds pretty good. How many of those do you think exist? And they'll say, well, a lot, because I have a lot of people coming in telling me that they can do that. And I said, well, that's really interesting. So let's look at the data. 3,000 hedge funds. How many hedge funds do you think met those standards over the course of the last 5 years? And they'll say, hundreds, and I'm trying to find them and stuff like that. And the answer is like 5. And those 5 you've never heard of, and you couldn't get into any, right? Because they're not taking your money because they, lucked out on the right tip. And so that, I think, is, realistic alpha is, I think, one of the most important things when you're managing money. If you're going to manage money durably over time, you have to have a realistic sense of how this works. And I think it's fascinating. People who have been in the business for like 30 or 40 years, like you say to them, like, hey, look, I've got a 1 Sharpe ratio strategy, that's got returns that are like on par with stocks. And here's why I expect it to be durable over time. And they're like, that is the kind of thing that I'm interested in. right? And you tell them about a strategy that's got like a 3 Sharpe ratio and double-digit returns and never loses, and they're like, "Nah, come on, man! Like that, there's no way that's going to happen. That doesn't exist." And those are people who have seen the reality of the challenges of generating alpha. So it's a lot better to focus on how do you create a high probability of a moderately good return stream. High probability of a moderately good return stream is a lot better to focus on than trying to create a very high yielding return stream that frankly has a very low probability of being successful over time.
And what are the types of strategies we're talking about here?
Well, I think again, if we think about the types of alpha, I think part of alpha generation is you have to go where others aren't, right? You have to have insight where others are not fishing in order to get sort of the best opportunities. And so because of the industry-wide desire to move to fast alpha, and frankly, a little bit because of the computing horsepower available, the increasing computing horsepower available to take advantage of small scale inefficiencies in markets or perceived strategies in markets. Basically, tons of resources have gone into, short-term trading, weeks, days, hours, and basically no one is trading like slow-moving macroeconomic dynamics anymore. And I think that's really interesting because what it does inevitably is it creates a lot more alpha opportunity for trading those sort of slow-moving alpha dynamics. So things like, longer term 3, 6, 9, 12-month type shifts in currencies or interest rates or, commodity prices, things like that. Those are the sorts of things that, if you go on the street and you start talking to people about how you've got, a great, 5% turnover alpha strategy on 50 liquid markets, they kind of go, yeah, but where's my 3 Sharpe ratio? And you're like, nah, but I can, if I get 50 bets in terms of financial markets and I can be 55-45 on any one month and I can diversify and I can put that together, that's a pretty good return stream. And so that's where I really think the opportunity is by seeing the sort of slower alphas.
And so with these alphas, are these discretionary? So you need, a seasoned person to identify these trends and put trades on, or are these? Can you capture them quantitatively and systematically?
Yeah. Now, of course, my inclination as a macro systematic trader and a builder of systematic investment processes is that you want the systematic part of things is really critical, but I think it can also lead you astray. And so recognizing that there is a real value, and I think certain managers deliver a real value in terms of bringing a qualitative, a rigorous yet qualitative understanding of how things are likely to transpire, paired with that systematic understanding in order to improve the overall probability of outcomes. And I think, that's when I talk about our HFND product, which seeks to replicate the gross of fees returns of the hedge fund industry, the way that we do it is we try and infer, or what we do is we infer the positioning that the hedge fund managers have on at any point in time. And we focus on the positioning, which is different from how previous strategies have done, which they focus on the decision rules, like systematic decision rules and structural factors and things like that. The positions are much better to focus on because the positions are the net of the necessary qualitative thinking about what's going on in the world at any point in time that may be different from the important underlying systematic understanding that a lot of these traders bring to the table. And it's really that pairing of the two that I think is pretty exciting. And if you just focus on one or the other, you're likely to not have as consistent a return stream. But if you focus on the intersection of those two, it will help guide and deliver a better return over time.
I mean, one of the challenges when inferring positions from the returns is, I mean, how do you know what their actual positions are? So how, what are you checking it against? So, there is, it's quite hard to infer those positions.
Of course, I mean, I think that is the challenge because we don't, part of the beauty of the hedge fund industry is its secrecy and its the inability to track exactly what positions it has on. And so, there's a number of ways that we triangulate how we see the world and the positioning that we are inferring using our technology. I mean, the first, of course, is to see how well we're tracking the actual observed returns on a forward-looking basis, which we can see daily, and so have a pretty good sense of the quality that we're able to track those returns. The other thing that we do, which is, I think, gives you a lens into it. So we use a systematic or a technology-based way of inferring those positions, and so don't override those positions with our own discretionary views at any point in time. But what we are doing is we're consistently looking at what is going on with the qualitative information that we're receiving in terms of what's going on with hedge fund positioning, and we're comparing that to the positioning that we're seeing with our systematic process. And so, as an example, a really good example is we saw hedge funds coming into the SVB situation as being positioned higher for longer. And that was an important, I mean, this is oversimplifying. We're trading 60 markets and like 10 different strategies, but just to oversimplify, we saw hedge funds positioned in that way, which was tilted in that direction towards higher for longer. And in that circumstance, we then saw, obviously, with SVB, essentially the markets repriced to a deflationary depression dynamic. And so what we would expect, given that circumstance, is that hedge funds should underperform during that period, right? That's what you would expect to have seen because they were positioned against what the incremental information was. And that's exactly what we saw, right? And if anything, actually, what came out over time, we actually were writing and commenting publicly about how hedge funds were experiencing a short squeeze, particularly in their 2-year rate positions, and then some of their cross equity positions, like being long value relative to growth and things like that. We were writing about that in real time because we were seeing how that was playing out. And then what happened was we actually saw a variety of hedge fund managers come out over the course of the next couple of weeks saying that that's exactly the positioning that they had and what drove what the outcomes were, which I think is pretty cool that we can see it with our technology faster than even anyone could understand it from a qualitative sense.
So you create a product that replicates the performance of hedge funds for a lower fee, obviously. But don't you find that this makes you just follow sort of short-term players, whereas you were saying earlier that you'd rather focus on the, areas that investors aren't focused on, which is the longer-term or medium-term dynamics?
Yeah. Well, I think a big part of what we're doing with this process by tracking the aggregate hedge fund views, in some ways you could sort of say like what we're doing is like we're betting on the best investors in the world and what their positions are, and like it's like betting on Djokovic and Federer and Nadal to win, right, over time. That's basically what we're doing instead of just betting on one of those different players. And so that basic idea, you have to have sample size. Those positions play out over time. They evolve. Like the wisdom of that crowd evolves over time, right? In terms of views on growth versus value or something like that is not the sort of thing that changes in a week or two. I think this idea that hedge funds move all their positions in a week or two, it's just not true. Like I ran a book. I know what it takes to move money through the markets. You can't move that fast because dealers will front run you. And then on top of it, the sort of aggregated view, right? The macroeconomic conditions and the aggregated views take time to play out. And so what we see is, turnover of 5 or 7%, something like that on a monthly basis in terms of these views. And that generates a pretty good return over time in terms of tracking what these managers are doing. And in many ways, I think that is slow alpha, right? Fast alpha is sitting there trying to catch every day's outcome and try and, bet that it's going to be red or green on any day on any asset. And what we're doing is saying, look, if you just take the collective wisdom of the most sophisticated asset managers in the world and you track what they're doing, it will be pretty good over time. And that's pretty good. And that's the sort of thing, pretty good over time is the sort of thing that could be beneficial to a lot of investors' portfolios. And that's all we're trying to do.
No, that sounds great. And what types of returns we talk about sharp ratios? What types of sharp ratios does this type of strategy deliver?
Yeah. I mean, hedge funds, what we're targeting for the strategy is the gross of fees returns to the hedge fund industry. So very important. Like if you go pull up, you might be familiar with the HFRI. Those are net of fees returns, which I like to say hedge funds have a fee problem. They don't have a strategy problem. Their strategies are great. It's just that they charge like hundreds of basis points in fees. So what we're doing is if you start with the gross of fees returns, what you see is returns that are on par with stocks or a little bit better over the last 20 years, give or take. With about half of the monthly volatility and about a third of the drawdowns. And that's basically what we've seen over just not over the last 20 years. We've seen that over the last 20 years, but also seen that over the course of the last, since January 2020, where, returns of hedge funds have been on par with stocks, but the ride has been a lot less painful.
Yeah, absolutely. That's very true. Now, I did want to sort of switch a couple of personal questions to round things off. One is, what's the best investment advice you've ever received over your career from someone else?
Yeah, well, I mean, I think a big thing that is critical for investors is diversification, right? And diversification is critically important, and it connects to the fact that even recognizing that even the best investors in the world are going to be wrong a lot, and so the only way to create a consistent return over time is by betting that as much as you possibly can. And the way that you do that is through diversification and risk controls, right? Because if you bet too much in one direction or on one particular insight, you have the risk of not being able to play the game anymore. And so I think too often people go all in on one view or one bet or one industry or something like that, and it is much to their detriment because they might get lucky, but they also might not get lucky. And if you have skill and edge, you just want to be able to bet that skill and edge as much as you possibly can for as long as you can, and you're most likely to succeed.
No, that's great. That's great advice. Now, another one is to get your advice, and this time for younger people who are leaving university, entering the big wide world of jobs and so on. What advice would you give to youngsters when they're leaving university?
I think the biggest thing going into the job market is take all the opportunity that you can. And I certainly would not be here where I am today without, the willingness to step up and basically do any job, help with any chart, run any analysis that was necessary. And often what that means is that, you aren't necessarily going to, it's not necessarily the glamorous work, right? But I think, the question is, what is your mindset when you go into a job? Is it, how can I help? Or is it, not my job? And if it's not my job, you're not going to succeed over time. And if it's, how can I help? That will take you a very long way.
No, that's great. Now, I did want to ask you about productivity. The reason I'm asking you this is that I notice you are on Twitter, and I find being on social media a big distraction. I mean, how do you manage your time? Because obviously you're doing lots of different things. How do you make sure that you're working effectively?
Yeah, I mean, a big part of what I've done for a number of years is just being very disciplined about the time or allocation that you put into the various activities, and in particular, trying to limit the bleeding of one thing into another. Now, look, we all struggle with this sort of thing, and so I'm certainly not above it relative to others. But I think a big part of what I've learned to be successful is trying to compartmentalize those different things. So you'll kind of jokingly see that I'll be tweeting primarily when I'm commuting, as an example, right? And so that's that's a good time. That's a good time where I can and a good form for me to do that work, which is very different from, say, I'm doing rigorous model building. That is not a good time to do that. But I don't need and having those other activities interfere is important. So really trying to compartmentalize those not necessarily distractions, because you got to do it and it's very productive, but the sort of the cross activity, I think, is really important. Email in compartmentalized ways, Twitter and social media in compartmentalized ways. And that should really open up space to be able to do sort of longer format work, which is really critical for, creative processes and building.
No, that's great and very apt advice. I did want to ask you about books. I'm a big reader and avid reader. What are some of the books that really influenced you over your career?
Yeah, I mean, I think in terms of the financial markets, I think the old Paul Volcker Changing Fortunes, which tough to find and expensive to buy, but if you are a little clever on the internet, you can get a PDF for free on that one. I think that's just such a critical, part of the challenge of being a trader is developing enough sample size of experience to have insight and understanding of what's going on. And in particular, I find that history of financial markets from, post-war through 90 to be super useful, because I was living in aware after 90 in terms of what was going on. And so that was super useful. I like Manias, Panics, and Crashes. I think that's such a great insight into the mindset that people bring on a day-to-day basis. And while not a book, I would highly recommend folks read the Economic Organization of a POW Camp. It's my pinned tweet, the first thing in my pinned tweet, which is a fascinating 15-page piece that basically, in that short form, covers every macroeconomic concept that exists in the world in the context of sort of the lens of how people organize themselves in the World War II POW camps. And so it covers everything from, supply and demand and prices and currency and trading and all of those different things, exchanges, so many different things, monetary, money supply, money contraction, all of those different concepts in that short piece, 15 pages. It's the single best piece of macroeconomic writing that I've ever read, and I read it probably 2 or 3 times a year and have for the last 20 years. Just to give you a sense as to how useful that piece is in terms of thinking about how the world works.
I'll definitely make sure to read it. Now, what's the best way for people to follow you and follow your work?
Yeah, for sure. In terms of thinking, getting more information about what we're doing at Unlimited with our replication approaches, you can check out unlimitedfunds.com. We got a lot of information there about our ETF. Also, you should check out the blog, which is on, I regularly write on topics related to, macro portfolio construction and asset management. And then the other, if you want something a little more day to day, definitely check me out on Twitter. My handle is @BobbyUnlimited, where, on my commute, as I said, I write about whatever the macroeconomic dynamics are of the day that I'm thinking about.
I'll make sure to include those on the links to those on the show notes. So with that, Bob, thanks a lot. That was really enlightening. We covered a lot of topics, and I do urge people to follow you on in all the different ways you described.
Thanks so much for having me. It was great.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.